From. I'm an international tax partner at BDO Amsterdam in the Netherlands, working for more than 20 years in international tax. Due to COVID, I'm at home right now, but my colleague Frederik Bologna is in our studio of BDO Utrecht, right in the middle of the Netherlands, approximately 30 kilometers away from Amsterdam. And as just a quick to know each other, we would appreciate if you can let us know in which country you are in. You can use the QR code, which is on your screen right now, or you can use the link in the chat. We will use the poll approximately 3 or 4 times within the next 75 minutes. And while the different locations will come in, let's go to the studio to Frederik.
Hi, Stephanie. Good to see you. And thank you all for joining. My name is Frederik Bologna. I'm an international tax director at BDO, and I'm also a lecturer of international tax law at the University of Amsterdam. I'm here in the studio with our guest Arjen van der Linden of General Electric. Welcome, Arjen.
Thanks for having me, Frederik.
Welcome. And in this session is also Christy Jonas, our esteemed guest from the European Commission. Welcome, Christy.
Good morning, good afternoon, everybody. Thank you, Frederik, for your welcome and invitation.
Thank you very much for joining, Christy. And also our 2 esteemed BDO colleagues, Monica Loving, BDO USA.
Thank you.
Hello, hi, Monica. And Ross Robertson, BDO UK.
Hi, everyone.
Thank you very much. So, Stephanie, you will be very curious for the results coming in on the poll. I see yes. A very large purple Netherlands. So it suggests many guests dialing in from the Netherlands, but also the UK, Luxembourg, Kenya, Mexico, United States, Switzerland, Scotland, UK. It's still changing. Thailand. Let's see which one is Turkey, Mexico, Malta, Brazil. Many. It's a very international session, so that's great. And Stephanie, do you know what's interesting? All of these countries have a tax rate above 15%.
Well, thank you, Frederik. That's indeed very interesting to see. And let's get back to the 15% rate in a minute. Just a small housekeeping matter. Given the limitation of time available, we will only address a few questions of the audience in the webinar itself. But we do encourage you to put your comments, observations in the chat. And after the webinar, one of our BDO colleagues will endeavor to get back to you shortly. Now, before getting some further insight from our guest, let's start with the basic rules of Pillar 2. Pillar 2 will affect companies that have an annual consolidated revenue of at least 750 million. Now, we remember that figure from the country-by-country rules. And as we all know, many of these companies may be available around the globe. Now, Pillar 2 effectively provides for a top-up tax in case the ETR, the effective tax rate of a group entity, is below 15%. Now, how do you determine the ETR? The ETR is in essence a fraction. The numerator of the fraction is the covered taxes. The covered taxes include, inter alia, the taxes accrued in the financial accounts, taxes imposed in lieu of the corporate income tax, but also includes complex tax-deferred adjustments. In addition, CFC taxes and withholding taxes are attributable to the group entity as well. As a denominator of the fraction, the starting point is the financial income out of the financial statements, so the accounting income. Then many tax adjustments have to be made. For example, dividends and capital gains from group companies. Then we arrive at the very rudimentary globe income. When the amount of the covered taxes divided by the globe income results in an ETR of less than 50%, a top-up tax will be levied up to the 50% rate in general. There are some carve-outs, but for simplicity's sake, we will not further elaborate that for now. The main rule under which the top-up tax can be levied is the so-called income inclusion rule. In the income inclusion rule, also called the IIR, the jurisdiction of the ultimate parent entity will levy the top-up tax. Alternatively, it's also possible for a country that has the effective tax rate of less than 50% to levy the top-up tax themselves. So in this case, that would be the subsidiary Y. That country will then levy the top-up tax, and that's called the domestic top-up tax. If, however, there's also a backstop rule, because if there's no qualifying IIR in the ultimate parent entity, or if the ultimate parent entity has a low level of taxation itself, then there's the backstop rule, the undertax payment rule. And in essence, the undertax payment rule provides of an allocation of the top-up tax between the entities within the group. And that's then based on a formula where you use the tangible assets and the number of employees. Now, what I've just done is provide you with a very high-level basis of the basic rules of Pillar 2. The rules are actually quite challenging and very complex, also because of the complex definition. Now, having said that, the European Commission aims to implement the IIR rules, the income inclusion rule, at the 1st of January 2023, whereas the undertax payment rule will be implemented on the 1st of January 2024. Now, I'm very curious to learn, what do you think as an audience? Do you think that the Commission will meet the deadline of the 1st of January 2023 for implementing the IIR rules, the income inclusion rule? Well, while we're waiting for the results of the outcome of this poll, let's go to Frederick in the studio.
Thank you, Stephanie. And Christy, I cannot see you on the screen yet, but I'm sure I will in a few seconds. Great. Hi, Christy, good to see you again. So you work at the European Commission, Christy, and you are part of a unit that is responsible for company tax initiatives. And amongst others, your particular sector is responsible for the Pillar 2 directive. So it's great to have you here because you're exactly the right person. When we asked you how is life in Brussels, you actually mentioned you commute from your house in Breda to Brussels. And is that doable?
Sorry, I had to unmute myself. Thank you very much. And indeed, I started in the COVID time, so I actually had plans to indeed move to Brussels. But now I'm a bit commuting, staying a couple of days in Brussels, and also staying the rest of the days in the Netherlands. So it's indeed due to COVID. I think most of us experience not being full time in the office this time, but hopefully, the COVID measures will indeed be a bit more less restrictive than they were the past period. But yeah.
Well, at least great that this is possible right now for you. So we have so many questions to you, and I had to pick a few ones. If we look at the Commission's publication last year, I think it was a notification, which was company taxation in the 21st century. And we now have this Pillar 2 directive, the proposal that came out in December last year. Can you explain to me and to the audience, how do these Pillar 2 rules fit within the broader Commission agenda and your vision for the next years?
It's indeed correct that last year, or the 18th of May 2021, the Commission presented a communication on the business taxation for the 21st century. And as highlighted in this communication, the EU constantly promoted ambitious tax reforms at international level. And as such, the both pillars, the Pillar 1 on the reallocation of taxing rights more to market jurisdiction, and also the Pillar 2, what was briefly highlighted, explained by Stephanie, on the minimum effective taxation of multinationals. Both pillars are high priorities of the European Commission. And perhaps another interesting note is that in this communication it was also explained that there is a proposal on the Business in Europe framework for income taxation, also known as the BFIT, which is a proposal that is planning to be launched next year. And this so-called BFIT builds on the global discussions like the principle of formulary apportionment in Pillar 1, and also the idea of a common definition in the tax base as under Pillar 2. But on the other hand, for example, a difference is that the threshold, for example, there's a high threshold under Pillar 1 and also under Pillar 2, while the idea for BFIT is that it should apply more general for business, so it can contribute and be a general improvement for companies within the single market of the EU.
So we can expect, Chris, is that what you're saying? We can expect more rules to apply to a much larger group of companies than the Pillar 2 and definitely the Pillar 1 rules would?
We are now working, or as Stephanie already explained, we have launched the proposal for a directive on Pillar 2, but in the communication there are indeed more proposals or intentions for proposals for indeed next year, like the BFIT, but that's more a general rule than the Pillar 2, for example.
Right. So we definitely gonna keep track of all these proposals. They should be very interesting. The next question I would have is, you mentioned, or I mentioned in my question, the OECD rules that came out 2 days before the directive proposal came out. And when you compare them, they are largely very similar. And of course, the timing is not a coincidence. Can you explain to us what exactly is the interplay between, on the one hand, the OECD inclusive framework developments, and on the other hand, the OECD, the EU and Pillar 2?
It's indeed correct, as you mentioned, that there are just 2 days in between. On the 20th of December, the inclusive framework, consisting of 137 countries, came forward or publicated the so-called model rules on Pillar 2. And in these inclusive framework members, also all our member states in the EU are included, except for one, but which is Cyprus. It's a bit a different story, but they also indicated that they are supportive towards the big global agreement. And indeed, our EU directive proposal came out on the 22nd of December, so there are indeed only 2 days in between. And to be honest, luckily we didn't have only 2 days for drafting, but to be honest, we already started in the summer. And as the European Commission, we are following closely the OECD discussions. And as we were already made the start during the summer, we were able to make amendments later on, and that's also necessary because, of course, we also have to take into account our internal procedures, like we have to discuss the proposals with other DGs, and also our legal service has to review proposals before they come out and become public available. So indeed, as Commission, we follow the discussions at the OECD level very closely, and as such, luckily, we didn't have only 2 days.
Great. No, that would be a very difficult task to publish such a directive in 2 days. So you mentioned you follow the work of the OECD very closely. Do you actually participate in that work as a European Commission?
Yeah, and indeed, as European Commission, and indeed we are also participating to the working parties and to the inclusive framework. But to be complete, we are not a member of the inclusive framework. That are our member states. But as European Commission, yeah, we follow the discussions closely indeed. So
yeah. And when you've seen this development at OECD inclusive framework level, can you share something about the directive that is now there, the proposal, and the OECD rules, and let's say the resemblance between the two and what you wanted to do with the OECD rules within the EU context?
Yeah, what you indeed indicated, it is the main aim of our directive is in fact to transpose the Pillar 2 rules or the OECD model rules into an EU directive. And as such, if you have on one hand the directive and in the other hand the model rules, you can see that the rules are closely related. And as such, yeah, you can basically say that our directive proposal is in line with these model rules, and there's also no intention for any so-called gold plating compared to the OECD model rules that were published in December.
And they're largely similar. Are there also some differences?
Yes, they are, because of course we are in the European Union, we have the single market and the EU fundamental freedoms. But let's first start. Our proposal is a directive. It's a specific legal instrument with also specific design elements. And as such, of course, we had to comply with these design elements of a directive. So, for example, if you look to the OECD model rules, there is a whole chapter 10, with all the definitions, and it's a very long list. While, for example, in our directive, we have to include the definitions if they are only used in a specific article. Then we have to include it in the article. And another difference is, for example, in the model rules, they are on alphabetical order, while, of course, a directive has to be translated in all the EU languages. So as such, an alphabetical order, would not make sense in English and then translated to German or to Dutch, for example. So therefore, the order is based on the order the definitions are used in the directive.
So can I summarize you, Christy, that you've more or less just translated the OECD work into an EU suitable directive, and you, of course, you had to comply with EU law, the fundamental freedoms, and that is the product we had at the end of December. That's indeed correct. That's it's we have to transpose it to a sort of EU directive legal instrument, and the other part is that we have to comply. And I think that's the most relevant part, is that we have to comply with the fundamental freedoms, and as such, you see that there's an extension to domestic subsidiaries and also to large domestic groups in the directive compared to the model rules. And then a last question in this session, Christy. So there's one thing that struck many who read the directive proposal, which is the IIR regimes, and to what extent they would be seen as IIR compliant. There is at least the idea that the directive has a somewhat own view on this comparison compared to the more open definition in the OECD inclusive framework rules. Do you want to say something about this?
If you look to the directive compared to the OECD model rules, I think if you look to the model rules, they are designed to only apply to the cross-border situations. While if you look more to the directive, we need to avoid any discrimination. So foreign subsidiaries of the group, they should not be treated less favorable than domestic subsidiaries or purely domestic groups. And as such, indeed, in order to comply with the freedoms and in order to avoid any discrimination between domestic and foreign entities, you see that indeed the income inclusion rule is extended to domestic entities and also to large domestic groups which are only active in one of the member states.
Thank you. That is extremely helpful. I see one question coming in. this is not a question I'm going to ask you. We may ask this question at a later stage. It's great people are raising questions, by the way. So I'm very curious. We had a poll before moving to you, and the results are in. And this is a beautiful result in the sense that it's a very nice percentage. So 1/3 of our audience thinks that the Commission will indeed meet the January 23 deadline, but no less than 2/3 of our audience thinks that the Commission is not going to make it by January 23. Christy, just turning back to you, do we have an audience with a very negative sentiment? Or are there perhaps still some steps, some hurdles that also the Commission acknowledges that it can take in the next 11 months to meet this indeed very ambitious deadline of 1 January 23?
Perhaps first making a general remark on where we stand now in the whole process, because obviously we launched our proposal the 22 of December, and now the discussions at the Council are taking place. So this means that the directive first has to be adopted by the Council, and then the second step is that after adaptation of the directive, then the Member States have to implement the directive into their national legislation. So a directive as such, you cannot say as a taxpayer of tax administration, we refer to the directive as such, but you have basically two important steps, the adaptation in Council and then also implementation of the rules by the Member States. So I think most of the people would agree, or I can imagine the outcome of the poll, that the timeline, it's very ambitious. Let's put it in that way. But I think on the other hand, it's also important to note that there's also much engagement from member states. And these deadlines, they are based on the famous October Global Agreement, which all the inclusive framework jurisdictions, including the G20, including our member states, agreed on implementation deadline of the 1st of January 2023, and then the so-called under-tax payment rule a year later. And also, if you look to our ECOFIN meeting a couple of weeks ago, also most member states ministers, they also were very supportive in the need for having an EU directive on Pillar 2. So
definitely. So it's an ambitious timeline, but there is a lot of momentum and support to get it done. So I'm sure you will get a very long way. Stephanie, I would like to hand the mic back to you.
Well, thank you, Frederick. And thank you, Christy, for your insight on this topic. That was very helpful. Thank you so much. Let's go to our next guest, Monica Loving. Monica is a dear colleague of mine of BDO US. She is the national practice leader of the International Tax Services Group within BDO US. She has also more than 20 years of experience in international tax. Monica, thank you for joining us.
Thank you, Stephanie. Appreciate the invitation.
Oh, thank you, Monica. And Monica, how does the US ensure that US multinational will be subject to the minimum taxation of 15% globally?
Yeah, it's an interesting question and very topical right now, given many moving pieces on a global and a U.S. level, Stephanie. So I thought to answer your question, maybe a bit of context to set the stage is important for our audience. And I'll start first with a bit of history, and then we can move into the current state of play in U.S. tax. As many may be familiar, we had a very significant tax reform in the U.S. in 2017. It had broad-ranging implications, many in the international tax area. We became a bit famous for our U.S. international tax vocabulary, the so-called GILTI, the Global Intangible Low-Taxed Income, and the BEAT, the Base Erosion Anti-Abuse Tax. So many are familiar with those terms, and I'll talk specifically here about the GILTI because that plays into your question. So GILTI is the provision from a U.S. standpoint that functions as a minimum tax on income of controlled foreign corporations of a U.S. owner, so on non-U.S. income. It does not encompass U.S. domestic income. Generally speaking, under current law, a basic rate of 10.5% applies. And I say this generally because the GILTI calculation is complex, as we absolutely see here from a Pillar Two perspective as well. And it may produce a differing effective tax rate result for a different U.S. company based on their mix of income, other tax attributes. The current GILTI rules calculate the GILTI inclusion on a blended basis across the group of the controlled foreign corporations. Some reductions or deductions in certain situations are applied against that inclusion. And then on top of that, our U.S. foreign tax credit system is overlaid. So many moving pieces to the calculation, but that policy objective of applying a minimum tax across non-U.S. operations.
Yeah, and so Monica, sorry for interrupting, but so your GILTI rules, they are mixed and it's blended. Is it possible to allocate it to a specific country, just like we have to do under the Pillar Two rules?
Yeah, we calculate a global blended minimum tax under the GILTI rules. But now we turn to current events, and the U.S. of course is watching and became an active participant with the OECD work, and so there is lots of discussion about our U.S. GILTI rules and how those will play in on a global basis. And U.S. tax reform came into the news again in 2021, and some of that impact was to think about how GILTI may be potentially changed to fit together into a potentially compliant regime. So this is coming out of our U.S. domestic tax provisions under a proposed tax reform plan that was called the Build Back Better Act. This was proposed in 2021, and at this time, it's no longer progressing through the U.S. legislative process. It did include a number of corporate tax changes, among lots of other potential tax changes, that included adjustments to the GILTI provisions that would more closely align to the globe. So, as you pointed out, Stephanie, right, a country-by-country approach versus blending potential rate changes as well as some other aspects of the calculation that would be more consistent with the Pillar Two proposals.
Yeah. So okay, that's very clear. Thank you. Yeah. So you briefly already then covered my next question, which was how does the US interact with the EU? So we still may have to do some work in the US on the GILTI rules in principle and some other legislation. Now, what will happen if the GILTI rules will not be amended? Will Pillar Two then affect the investments in Europe held by US multinationals?
Yeah, I mean, that's a very hot topic of discussion. I think, if GILTI is not a compliant IIR, this adds a significant level of complexity and potential opportunity for double taxation. And I think it's important really to talk about two streams of income for a U.S. multinational and their EU subsidiaries, the EU operations, because the U.S. GILTI rules, as I mentioned, those apply to CFC income, so income outside of the U.S. And those GILTI rules, whether they remain under current law as is or any changes to those clearly apply to U.S. groups and their foreign operations. But the question will become, and important to flush out from a modeling perspective, whether GILTI is compliant or not a compliant IIR, as to whether there's any other IIR impact in an intermediary or other operating jurisdiction in Europe, and then even more complicated to that, how that plays in with our U.S. foreign tax credit rules and ability for double tax relief there.
Yes. So what do you think that may happen then? So if the GILTI rules will not be amended, there's a risk on double taxation?
Yeah, depending upon the group and their structure, there is a risk of double taxation, and I think it goes to modeling the impacts and determining how that group may organize or reorganize or approach that total tax impact from GILTI and other IIRs. But also, focusing on maybe a second piece, and that's the income of the U.S. company itself from U.S. operations, branch operations that are directly flowing into the U.S. That income would never be subject to GILTI, and so another piece of the puzzle to think about from a U.S. multinational group is the UTPR, right? And what if, based on the circumstances of that U.S. operation, that the U.S. perhaps has an effective tax rate itself that falls below 15% ETR. How does that play into the global picture?
Yeah, and if you then can choose, would you like to see the U.S. be qualified as a qualifying IIR? Or are you saying no? We rather than be considered not as a qualifying IIR? Or is that something difficult to answer now?
I think it's a difficult question to answer, and I think the perspective is probably different depending upon each group and how their tax attributes and income falls out by jurisdiction. But I will say it will add a significant layer of complexity.
Yes. Yeah, because if we make exceptions for the US on the IIR rules, will other countries follow? You have other big countries. Well, anyway, thank you so much for your valuable insight, Monica. And I was wondering, also given the time frame, actually, Frederick, we may have time for a question.
Yeah.
So I saw that there are many questions coming in. But maybe first to Arjen.
The question, and I think Monica already covered it, what happens if US Congress does not approve the implementation? That's a pressing question among our audience.
Yeah, and maybe Frederick, I can just touch on that again very briefly. So as I mentioned, there was some proposed legislation in the later part of 2021 that was called the Build Back Better Act that currently is in Congress and not at this point progressing. And so lots of discussions around Washington, D.C. as to what potential other alternative paths would be for maybe making that legislation into smaller pieces and parts of that would gain some bipartisan support within Congress. So very much a watch and see in Washington, D.C. over the next few months.
Great. And a second question, Monica, is so everyone was really happy, at least a lot of people were really happy that Janet Yellen committed to this international tax reform in October 21, because that was a primer. You had been out of these discussions for quite some years. Will these domestic discussions in the US potentially lead to the US retreating again from their commitments?
Well, I think Secretary Yellen made some comments, I think just earlier last week, to reaffirm the administration's support on moving forward as a part of course of the global agreement. So it will be now in Washington D.C. the administration working together with Congress to pursue options.
Right. Great, thank you. Stephanie, shall I move to our guest in the studio here, Arjen?
Yes, please.
Yes, great.
Good to see you, Arjen. Welcome.
Yeah.
Thank you. Thank you for having me today.
Great. Good to see you. So to those on LinkedIn, you will be a familiar face because you are really a tax influencer, I must say. Whenever there are new proposals, legislative developments, case law, you're always one of the first to provide very detailed comments, analyses. But in addition to your work on LinkedIn, you actually have a day job.
That's correct.
You are a tax director at General Electric.
Yes.
And previously you were a chair of the tax committee of the American Chamber of Commerce.
Yes. I started at GE 10 years ago as tax director for the region. In 2014, I picked up the chair of the tax committee of the American Chamber of Commerce in the Netherlands, doing quite a bit of lobbying work, so making sure that the the investment climate, the broader investment climate in the Netherlands, particularly for US multinationals, was under the attention of the politicians in The Hague. We had success, we had some non-success, but in general we had good traction. I stopped that a year ago to again give the seat to my successor, Lodewijk Berger. And since then, I am a little bit less present in the media and in social media because you have to give the opportunity to others to do what they need to do.
So great, and still make time to be here, which is
It's this. Thanks for the invite again, Stephanie. Also, this is really something that goes to my heart because it is, this is a paradigm shift in the way we think about international tax and taxation companies. When I started 20 years ago, this was, this could never, you couldn't even envision this was coming. This all started, I think, in 2012 in Leningrad, St. Petersburg, when the G7 met and said we have to do something about tax avoidance. Then it became bigger and bigger and bigger, and this is really the current state of the file. And of course, it is unbelievable what the Commission, but also the OECD have achieved in gathering the nations of the world against, in rallying them really in accepting this framework. So that's a great achievement by those people.
Yeah, it is indeed. It's a great political achievement, administrative achievement that they've done so.
Right.
But now, of course, the question is: you are a tax director at a multinational that is present in across the globe, almost every jurisdiction, I would say.
Yeah, we are present in more jurisdictions than have adopted Pillar Two or have supported it.
Yeah.
We just heard from Christy. We just heard from Monica. Christy says Brussels wants to do this, and it's going to happen this year. I learned not to bet against Brussels, so I am in the 33% that says, this is going to happen. We heard from Monica that guilty by country is not a given. So for a regional tax director of a US company, that is a stressful position to be in.
Yeah.
Because we certainly have to, recognize and that, it's not unlikely that in another 9 months we are looking at having to do all the global tax work and be caught by it or not. So
it's stressful, but on the other hand, you have to stay in control as a tax director.
Right.
Yeah.
So you take the opportunity and you build something out of it. And the way I think you need to do that is twofold. First, it's very overwhelming, right? And depending on your group, depending on the company you work for, it may be extremely overwhelming or just a little, but it's a lot of work coming your way. Now, the way I think about it, to keep control, you first, as with all things tax really, you first have to have a very deep understanding of what the rules are. What are the rules? How do they impact us? Stephanie already mentioned that your profile, the rules will be different whether you are, for example, a EU parented multinational or a US parented multinational. Yeah. If you're an EU based multinational and this proposal gets enacted by 2023, every group company in your group you will need to figure out what the ETR is. If you're like me, a director of a US multinational, President Biden or the Democrats don't get their good guilty through passed, then you have an issue, but the issue is only to the extent in 2023 you have companies underneath European, you have European companies and companies underneath Europe, right? So your scope is smaller.
Yeah.
And perhaps what you should do to stay in control, perhaps you also recognizing the changes in the US tax play in the last years, maybe this is a good time to have a fresh look at your structure and say, well, do I really need those holdings through the Netherlands, through Luxembourg and what have you? those old legacy deferral structures that are broken but perhaps never really cleaned up,
Yeah.
maybe this is the time. So that's a bit of self-help you could do to keep control.
Yeah. Can I move back to the point of a good understanding of the rules?
Yes.
So it's you have it with you. Can I?
Yeah.
Can I take it? So
It's,
you can show it. It's a nice package, of course. The directive printed format.
Yeah. It's.
Are the rules sufficiently clear to you to get this real understanding of the impact? There's so many definitions.
There's many definitions, but I think the way it is, we heard from Christy how it was done. I think it's a marvelous job, and it is 80 to me it's 80. You have to read it 2 or 3 times. It's 80% clear what's trying to be achieved. One question I would have for Christy is, or maybe we answer that later, but the OECD will come in March, April with additional explanations to Pillar 2. Will Europe, will Brussels incorporate that in the next version, or will they reference those explanations and accept them, bring them on board into the proposal, just as we have seen with the ATA 2 directive and the hybrid rules. So that would be a point to further improve and make clear the product. But I think overall, everybody understands what the aim is, what's coming, and the work that needs to be done.
Yeah, and knowing you, I must say, only from your written work and your comments, I'm sure you have some observations on the directive and perhaps a few points that you would like to see changed in the rules.
Yes.
Could you share?
Well, I think, and this is water under the bridge. So to the audience, maybe this is totally irrelevant, but if you talk to local politicians, maybe it's a point to again make. And that's the point that we are building now a system which is extremely complex. Why is it so complex? Stephanie already mentioned it. We will have to walk back net income. We will have to walk back tax expense, both in your financial accounts, to a total new concept of GloBE income and GloBE tax. And we divide that to get to the 15%. And that walk is going to be a lot of work for tax accountants. It is not a benign task. It's a big task. Now, why are we doing this? We are doing this to get a comparable basis so that we can compare tax rates. That's logical. But why do we need that? And here comes my point, right? And this is my big hang up against this plan. If we have 136 countries in the world supporting this framework, would it not be enough if we have 136 countries saying we will impose a minimum tax of 15%, we will subscribe to the view that funky territorial regimes, crazy IP box regimes, interest box regimes, notional interest deductions for equity, that's all bad. That's blacklisted regimes. You have those, you're in trouble. If you don't have those and you have a rate of 15%, it's okay. Isn't that a much better way, or at least, well, I'm not going to say better, but isn't that a much more effective way of achieving what we all want to achieve, which is at least a headline tax rate of 15%? And if we could do it like that, the amount of work for the tax accounts in recompiling those tax bases is not needed. So that's what I dislike about this. I mean, it conceptually, this is really well done, but to me it's overkill. And then to Christy again, she mentioned that the legal bureau of Brussels of the Commission has reviewed this. I would assume they also review whether it's proportionate. And I would be very interested to learn what the reasoning is why this is proportionate versus the alternative I basically just mentioned, right? Yeah. So how does that work out?
And then these 100 or so pages could be just 5, no IIR, UTPR, and all.
Exactly.
Just 15% effective tax rate. That's it.
And is that not good enough?
Yeah.
Question mark.
And you mentioned tax accountants a couple of times. I'm sure you have some in your organization, quite a few, I would expect. Where is this Pillar 2 discussion? Where does it fit in organizations like yours, like many of those in our audience, I would expect.
Yeah.
Do you think Pillar 2 is going to be a tax accounting, reporting topic? Or is it a strategic topic that could also lead, complete restructuring?
Well, that's the interesting point, right? So this plan has something for every type of tax practitioner. If you're a tax planner, you should be getting your hands on this and start, crunching numbers. Maybe use CBCR data on that to, get your first bearings. What companies need to get out from under Europe like tomorrow, right? Because uncertainty, you don't want that. So take charge. Going forward, that's an immediate opportunity, I would say. An immediate thing you should be doing and reviewing. More structured is, of course, the process. How are we going to handle this going forward? That's where the tax accountants, that's where the tax compliance team is going to take place. And then you have to consider that, and I haven't even quite distilled this myself in my mind, but you have to consider that you have to start with if you're a US multinational, your US GAAP financials.
Yeah.
Now you need to walk back your US GAAP financials to Globee income and to Globee covered taxes. But when you make that walk back, it is, you will have to use local knowledge. So the knowledge from the people that prepare your stat accounts, the knowledge from the people that prepare your local tax compliance file, that is completely necessary to make those walk backs. Yeah. So I'm struggling still a little bit if who should have the ownership in this process. Should it be the tax accountants? Yeah. Should it be the local people? I think it's probably ends up being the team working together.
So you're also saying completely centralizing Pillar 2 in one central, let's say, tax support office in one country is undoable. Even all the local adjustments that still need to be made.
Yes.
Local knowledge.
Yes, and that's mostly from looking at my company. Yeah. Sometimes looking at the US GAAP accounts of the work I've been involved with, and then thinking, wow, this is different than what I thought it would have been. Yeah. So there is this translation going on from local stat and local tax to US GAAP. You also have a US, there's also a whole US tax overlay on all of that. If you look at losses and whether you have booked a DTA, yes or no, for a local loss, depending on what happens in the US, for example, whether your Dutch company is a disregarded entity, yes or no, you get a totally different answer. So if you're going to use the US GAAP data only, yeah. I fear that you will be missing out a lot of components, which the local team will have. So it probably needs to get some kind of a hybrid mix.
So we need good tax accountants, local knowledge, and perhaps even very good data scientists to structure.
Who can map it out. And then later on, the tax planners, when this house is in place, the tax planners will start taking interest and will start looking at the numbers and say, maybe we should refinance this, maybe we can retool our supply chain, what have you. But to me, that will come at the back end. For now, the focus must be on where are your risks, what needs to be done to identify them, talk to your auditor, because if you need to book a global provision, it's going to be in your financials 2023. Does your auditor want a view, right? Do they want to audit the process? Do they want to understand the process? So that's all things you need to start thinking about now.
Yeah, this is extremely insightful, Arjen. Stephanie, I would thank you very much for it. And Stephanie, I would like to give the floor back to you and Ross.
Well, thank you, Frederik, and thank you, Arjen, for your input. I actually have a few other questions also for you, because it seems like you suggest to just make it very simple, get your local financial statements, apply 50% on it, and if you're above it, then you may be okay. If you're below, you may not. Well, that maybe is too simple, but it's clear that you have some suggestions for making it more simple than it currently is worded. Thank you for that. Let's go to our next guest, Ross Robertson. He's an international UK tax partner in the BDO UK. But Ross is also our leading spokesman for BDO Global on global tax reforms, and he has developed BDO's interactive tool on unilateral measures, around the globe in relation to Pillar 1 and 2. Ross, thank you for joining us. Thank you.
Thank you for the warm introduction.
Ross, now we have just learned that 136 states have committed to Pillar 2 and 27 states are covered by the EU proposal. Now, UK, Brexit, what will the UK do with the Pillar 2 proposal?
So I think I'd start by saying that the UK had repeatedly referenced back to the deals brokered in June 2021 by the G7, which was, of course, when the G7 was led by the UK under its presidency. And I think what we should take from that is that the UK is politically very invested in moving forward on these rules. So there's a current consultation on the implementation of Pillar 2 into domestic UK legislation. That consultation was issued on the 11th of January and will close on the 4th of April. Very similar to what we heard about the approach that the European Commission is taking, the UK view is the model rule should be adhered to as closely as possible. So the consultation is not about policy rationale or design features. Really, the focus is on the application and implementation of the rules. And any comments that are made on design would have to be very clearly couched in the context of solutions to clear issues in application. So that's the first point. I think the UK commentary acknowledges the ongoing work by the OECD around the implementation framework, for example, but it's moved forward with its own consultation because it wants to give business sufficient time to input. It recognises this is a very significant change and it wants business to have the opportunity to influence how the rules are sort of implemented in practice. And I think there's also a systems point here. There's a lot of businesses here in the UK that are saying they cannot wait much longer to begin to design and implement systems and processes that will enable compliance with the rules if they are indeed to come into force from 1 January 2023. And I think that aligns closely with what Arjen's been saying as well.
And if you, we just spoke about with Monica also on the guilty rules, right, and the income inclusion rule. How does the UK approach this? Will they recognize the US as a qualifying IAR?
So the UK has not yet shown its hand in relation to that particular question. My instinct is that the UK legislation is interpreted in a very literal way. I think purposive interpretation is perhaps more common in Europe. In the UK, it's very much literal interpretation. What do the rules say should be done? And on the face of it, guilty does not align to the model rules. And therefore, my instinct, but it is just an instinct, is that the UK would not recognise guilty as a qualified IIR. So I think it's going to be really interesting to see how that dynamic plays out. And the UK government does reference within the consultation that it's following closely how events are unfolding in the US. The US is, of course, an important treaty partner to the UK, as it is to the EU. And there's a real desire that there does not result in competitive tension as a result of the application of different types of rules in the US versus the UK. So the UK rule is very much, we will stick as closely as possible to the OECD model rules. We will flex where absolutely necessary to meet the specific requirements of UK laws, like the European Commission with meeting the fundamental freedoms. They want to hold the line on the 750 million euro threshold. So the model framework does provide potential for flexibility in nations applying different thresholds, but the UK view is that is the right threshold and we all need to hold the line on that. One difference between the UK versus the EU approach is that the UK approach is not anticipated to apply to solely domestic groups. So one of the aspects of Brexit is we're not restricted by the fundamental freedoms. And so the UK approach is intended to only apply to multinational groups. And then there's a lot of conversation around sort of safe harbors and implementation mechanics, which is probably too much detail for this conversation. But what I would say is that the UK has stated a clear intent that it is planning to implement a domestic minimum tax at a rate of 15% for groups above the euro 750 million global turnover threshold, and likely for both UK and foreign-headed groups. So I think that'll be an interesting dynamic to see how domestic minimum taxes play out across the world as well. And then just one final point on timing. So the UK has stated an intent in the consultation to implement the IIR with effect from 1st of April 2023, and the UTPR and domestic minimum tax from 1 April 2024 at the earliest. 1 April is because that's when our UK tax year begins, but there's an open question at the moment as to whether its accounting periods beginning after those dates or ending after those dates. So it does remain possible that the UK could implement with effect from 1 January 2023 or even earlier, depending on the relevant financial statements of a company.
So that's actually making it also more complicated with the UK. What about the rest of the world? Do you have any insights on? And what I'm also wondering if US may do something different, UK may have slightly different. What will that do with the other countries around the world? Do you have any insights on that?
Yeah, so I think that there's general concern, is how I'd phrase it, in how the implementation of the rules can be effectively coordinated on a global basis. The UK consultation makes reference to this, as do various other publications, and the UK government is seeking input on how consistent global coordinated implementation of these rules can be more effectively achieved. I think when we start to look globally, there's a point about the approach to translation of the OECD model rules. So this concept of qualifying IIR, qualifying UTPR, qualifying domestic minimum tax, but there's an open question as to how close do they need to be to the model rules in order to be qualifying. And you might get to a very different view on that, depending on whether your legislative approach is a purposive interpretation of, does it achieve the broad ethos of the rules? You might say, well, guilty arguably achieves the broad ethos, or you might say, on a literal approach, does it do what the model rules say? In which case, guilty does not, for example. But that's not just relevant in the US concept. It's also relevant when we're starting to look at other territories around the world and how they move forward with implementation. I think this concept of what is qualifying and what is non-qualifying and how that is determined through the peer review process will be hugely important in the effective rollout of the rules on a global basis.
Sorry, Ross, because what I was also wondering, now one of the options to levy the top-up tax is the domestic top-up tax. Now, from what I'm hearing, why wouldn't countries just introduce domestic top-up tax?
I think
but effectively the IIR rules will not apply.
Yeah, I think it's a good question, and I strongly expect that most territories will implement a domestic top-up tax. I think the key point is whether it is a qualified domestic top-up tax, which will be subject to the peer review process, and that's one of the things that we expect to be covered in the OECD implementation framework. So I think there's a balance, perhaps, of the impact on inward investment decisions of having a domestic minimum tax. But I think personally it's difficult to see an adverse impact on the assumption that UTPR rules proliferate around the world and that qualifying DMTs also sort of spread around the world. I think if a domestic minimum tax is not qualifying, then it risks disadvantaging domestic businesses in a particular jurisdiction because of the way the mechanics of the rules work. It would basically mean that if it's non-qualifying, then you don't benefit from the substance-based carve-outs, which we haven't really talked about, but that sit within the GLOBE rules. So in-scope businesses would pay more tax under a non-qualified DMT probably than they would under a qualified DMT. So I think that from a personal perspective, and just to echo what Arjen said in terms of sort of the path of least resistance to implementation, what I'd like to see is if qualifying DMTs spread, which I strongly suspect they will, then I'd like to see those countries whitelisted so that effectively those countries do not need to be considered in the Pillar 2 calculation.
Yeah. Good suggestion. Thank you. Thank you. And then another question, Ross. Well, as you know, in order to attract foreign investments, offering a lower corporate income tax rate was very popular last few years. Now, that may no longer be of any interest. Do you think that there will be any other competition between the countries in order to attract foreign investments?
So from the UK perspective, the UK has not publicly stated any intent to broaden incentives, but other countries have. And I strongly suspect that different forms of incentivization will be offered to drive businesses to establish and in particular build employment bases in a territory with all of the resultant economic benefits. And so what I think we'll see is territories looking to effectively move towards reduction in non-covered taxes, so sort of non-income or corporate income-based taxes, things like stamp duties, employment taxes. I think they'll sort of try to compete on reduction in regulation or compliance burdens in other areas where they can. And perhaps we'll also see new incentives in non-covered areas, such as employment incentives, or perhaps sort of a growth in grants being offered. And so I do think that probably for my money, the most effective incentive would be those incentives based around employment tax reductions or grants or something of that nature. When you think about it in the context of economic policy, what countries are ultimately trying to do is encourage businesses to employ people in their territory, pay them high wages, and then those people will go out and spend in the economy. And so I think sort of trying to balance the increase on the business side with a corresponding reduction in employment taxes on the business side is something that we'll see spread.
Yeah, interesting. So we'll create a new round of competition then. Well, thank you so much, Ross, for your valuable input on this. I see it's already 1 minute over 5. We have 15 minutes left, and we're very anxious to hear the audience view on 2 other statements. So, and hopefully we have some time for some other questions to our guests. Now, the first statement that we would like to get a yes or a no answer to is: the globe rules will make my company reconsider the countries in which we operate. So again, the globe rules will make my company reconsider the countries in which we operate. Now, you can answer the question with a yes or a no. And while we're waiting for the results of this poll, Ross, would you like to answer this question? What is your view on this?
Yeah, so we'll see if I can lead the witness. So my view is a clear yes. This is a significant change, and companies need to reconsider how they operate globally, but that may not necessarily mean that they ultimately change their operating model as a result of this. I think there's 2 different timeframes we need to look at. So in the short term, there could be a very interesting dynamic depending on how the pace of implementation varies around the world. For example, if the EU were to implement faster than other territories, in particular in relation to the USUTPR, then for a non-EU headed group, there may be a disincentive to invest in the EU, as investment in people or assets in the EU could lead to a top-up tax in the EU under the UTPR. So that could influence short-term investment decisions, I think. In the longer term, I think the smaller potential differential in tax outcomes could mean that the tax upside of establishing in a territory which has previously sort of competed in terms of its corporation tax policy, the balance of that equation potentially changes. So it's always been a balance of what is the economic upside versus how does that influence the business in terms of, ability to attract and retain talent, local infrastructure, and so on. When you sort of balance it with the current international tax framework that requires substance in a particular jurisdiction for that jurisdiction to effectively be respected under the international tax framework. So ultimately, I think what is right for the business will prevail, but the tax input into that business case decision of fiscal measures versus sort of talent and infrastructure and so on, the balance of that changes. And it may mean in some circumstances that the business effort of maintaining substance in a particular territory no longer is worth it in light of the fiscal advantage.
Thank you. Thank you for your comments on that. And Arjen, do you agree with Ross, or do you have a different view?
No, I fully agree with all that Ross said. A business does not, contrary to what the media would like you believe, structure their operations around tax. Tax is of course a factor, but it's rarely the decisive factor, especially in 2022 when, like Ross mentioned, substance is a key point too. I do think that there will be winners and losers in terms of countries here. And that's for the simple thing that certain countries that are currently below the 15% rate, they can, they will have to move up, right? Because otherwise they give away the top-up tax. Mm-hmm. But that, just to, as Ross mentioned, and I think that will reinforce something that we have already been seeing in Europe. And let me explain. What that means is that if you're an Irish company or a Swiss company, and you're going to be levied with more tax, it's pretty likely that the local government will use the windfall of those proceeds to further improve the investment climate. So an Irish government or a Swiss government or the Hungarian government, very eager to attract employment for their people, they would be wise and able to invest this windfall in lowering employment taxes, giving more incentives. Whereas the more Western European countries, if you like the Dutch, the French, the Germans, we're all much higher. We need that revenue. We cannot go down. So in a way, whereas, and this is a question in my mind, but and maybe Ross can again, comment on it too. But my feeling is that this all means that the benefits of the system are now being fixed and bolted in the favor of the currently lower taxing jurisdictions that are moving up to 15%, like the Irish, like the Swiss, like the Hungarians probably.
Do you agree on that, Ross?
It's certainly an interesting perspective, and I can see the logic in it for sure. I think that there's so many complicated interacting dynamics here, and it's one of these areas where I think it's very difficult to look at sort of Pillar Two in isolation. I think there will be responses to Pillar Two. I mean, we've spoken about other incentive regimes and so on, and I think until we start to see how the dust settles in relation to that, it'll be difficult for us to fully understand exactly what it might mean. But I do think that, in general terms, any increase in the level of taxation is going to sort of reduce the ability for a company to invest in its growth and its own sort of business, and therefore local economies will need to respond to try and find ways to maintain level of investment, because probably investment has dropped anyway as a result of the pandemic. So we've got sort of multiple competing forces here, which I think policymakers will have to balance carefully.
Okay, well, thank you, Ross. Thank you, Arjan. Let's see what the results of the poll are. Okay. Almost 50-50. Well, a slightly higher percentage for the yes. Well, thank you. Then we go to the next question, and the next question is: Pillar 2 will significantly increase my company's compliance costs, and you will see it now on your screen again, so please fill it in. So again, Pillar 2 will significantly increase my company's compliance cost. Please answer it with a yes or a no. And in the meanwhile, I would like to get a view actually from Christy from the European Commission. Has it been considered that it must be a compliance burden for multinationals, the Pillar 2? Could it be?
Yes, I think if you read the model rules and the directive, I think most people, or as light on the table, it's a quite big package of paper. And I think most people, they would agree that the rules are quite technical and detailed. But as Arjen already said, it's very special having such big global agreements, whereby 137 countries agreed on, and what you see, it's a process of technical discussions with technical experts from like India, China, South Africa, the United States, Germany, Brazil, etc. And all these countries, all these experts have different or their own views, their own interests and backgrounds. And in order to get a compromise and to get everybody on board or on this Pillar 2, the complexity of the rules it's unfortunately a sort of byproduct of this whole process. But nevertheless, as already mentioned, the work has not been finished yet. Currently, work is done on the commentary to the model rules, which should provide more guidance. And also, what already mentioned by Ross, work is done to develop an implementation framework in which further simplifications, possible safe harbors will be further discussed. And in this view, also a public consultation shall take place later this month. And yeah, the European Commission is following this process very closely.
Thank you. So is your answer then a yes or a no?
It's a bit in between. I think we have to see how the future will develop as well.
Yeah. Okay. And it also says significantly. And Arjen, what is your view on it? What would you have answered the question? Yes or no?
No, 100% yes, Stephanie.
Yes, that's wonderful.
There can be no doubt that the proposals as they are today, for an American company, right, as I'm talking for, but Europeans the same, but for an American company, if President Biden doesn't get his qualified IRR, then the Americans it's a big task. It's basically a new tax return for every country, for every company in any jurisdiction. So it's double the load of whatever it is today. So that should not be underestimated.
Thank you, Arjen. Now let's see what the audience, how the audience came back to us. It's clear answers. 86% has answered it with a yes, significantly increase of the compliance costs. Well, thank you so much. That brings us to we have come to the end of this webinar. And although it's contemplated to have the rules, the Pillar 2 rules be implemented on the 1st of January 2023, for a great part then, it's clear that still some steps and hurdles have to be taken before we get there. But luckily we have heard that the implementation framework is on its way. So, well, for further insights and updates, you can follow us on the digital economy on our global website. Well, that remains us then with thanking all the participants. Thank you so much for attending. And a special thanks for our guests, Christy, Arjen, Monica and Ross. Thank you so much for your valuable insights on the potential impact of the Pillar 2 rules on the multinationals, but also for the countries. And yeah, let's go back to the studio. Frederick will have a small present for Arjen. We also have had it for Christy, but unfortunately, ultimately, you couldn't come to the studio, but we'll send it home to you. And Ross and Monica, thank you, but you'll get your present when we see each other again at a conference of video. So that's okay. So thank you all. And now let's go back to the studio. Thanks, Frederick.
Thank you, Stephanie. And indeed, Christy, Monica, Ross, thank you very much for your views today. Arjen, of course, thank you very much for coming for our discussion.
Thanks for having me, Frederick.
Very much. Indeed, two gifts for you. The first, a wine.
Thank you.
Which you can take. And the second, you are going to be very involved in a demerger process in the next period. That's public. Everyone can see this. This is a book on demergers written by myself.
Right.
So,
well,
happy reading.
Thank you very much. I can certainly use that. Thank you.
Great. Thank you all. Bye-bye.